Hello and welcome to the Presidio Group's Drive-In Live series. My name is Jason Stein. I'm one of the firm's managing directors. I'm joined here by Kevin Tynan, Director of Research for the firm. Welcome in, Kevin.
Thank you.
We're thrilled to have you here for 30 minutes. This is our Friends of the Firm pilot launch. We know how valuable your time is and appreciate you spending it with us on this, our maiden voyage. At the conclusion of our session, we'll have an immediate 3-question survey. Thanks in advance for taking that. In this Drive-In Live series, we're excited to provide a unique perspective on the earliest dealership and industry data and discuss the potential impact of tariffs. The dealership data is provided through Presidio's exclusive partnership with NCM Associates, and it represents more than 4,000 dealers across the United States. Simply put, this partnership enables us to provide you with the most robust data sourced from the most rooftops in the timeliest manner available in the market. We're proud to be associated with NCM's position as a thought leader in the space. Overall, our goal is to set an industry benchmark, digesting what the data means and distilling it to those who matter most. Over the next 15 minutes, Kevin and I will offer our insights on the dealership data, tariffs, and a broader 2025 automotive industry outlook. Then we're going to do 15 minutes of Q&A with you. Speaking of that, we'll ask you to share your feedback and ask questions today. Please click the top right Engage button in order to be part of this broadcast and ask us some questions. And as a reminder, if you want to access this session on demand or have the ability to share it with your team, please set up your username and password with Presidio's LeaderPass channel. The one-click access is valid for today only. So Kevin, now that we've handled the quick logistics, let's get to it. The first quarter of 2025 marked a significant turning point for franchise auto dealers, as you know. After nearly 3 years of falling profits, the average dealership in the U.S. posted a gain in earnings. And that's according to that Presidio-NCM average dealership performance benchmark. Our president, George Corollas, calls the first quarter a critical inflection point. And in the long term, the first quarter of 2025 could stand out as a turning point for the industry. Here are some highlights. Dealership performance is finally stabilized after years of declining profitability. The data may suggest a new normal far better than the typical profit posted before 2020. And the average dealership's pre-tax profit for the first quarter of 2025 was 1.8 times 2019's level. What do you see when you look at the NCM numbers?
Yeah, and I think all that data is very telling. I think we were getting to a point where not only easy comps compared to the year ago, but I think and I'll talk about this a lot, supply and demand balance. Yeah. And you started to see manufacturers get a little bit or learn the lesson of the pandemic, the COVID period. But the question is, as we try to project that forward, what does the first quarter data mean as we deal with a tariff environment, what I would consider a potentially supply-constrained environment going forward? So I'm not sure there's that many lessons that we can take specifically from that first quarter and look out through the rest of 2025 and say, we're on this trajectory and it's going to stay that way. We have the potential for things to be very, very different in the second quarter and beyond, and even into 2026.
Thanks to some outlying efforts, which we're going to get into tariffs more deeply. I want to focus on one thing. In Q1, the Presidio-NCM average dealership profitability index turned upward, a score of 180. That surpassed its mark at 173 at the end of 24. The index tracks profitability for the average store going back to 19. So what's your read on those figures?
Yeah, and again, I think that from the retailer perspective, a lot of this is so dependent on that supply-demand balance. And I was just looking at some of the data. When inventory was rebuilding, right, 2022, which was peak profitability for dealership, it was also the trough in terms of inventory. Inventory fell below 1 million units at one point, but demand stayed level. So what you got was great profitability for the manufacturers and for the retailers. Now what's happened is that inventory started to rebuild, and then profits started to come down. Now it eventually normalized above where it was in 2019, but it was on its way down. And the data point that I saw was that it took 10 months to go from 2 million units of inventory to 3 million units of inventory. In the last 10 months, we've gone from 3 million to only 3.1 million. So
Suggesting some religion on the
yeah,
automaker's part.
so the idea that we're not going to run right back, because in 2019 that number hit 4 million,
Right.
and there was no profitability at all, right? That was just scale for scale's sake. So there were some green shoots there in the data. You're just concerned about what the sort of artificial environment, tariff environment, supply constraint environment does going forward. But it was definitely on a good path.
We've talked at length about how much brands matter. Let's also talk about luxury and import brand stores. They improved in Q1 while domestic brand stores continued to slip. So what do you see here? Does it support the theory?
Yeah, it does, because when you look at inventory, the Asia-based brands are always tight on supply, almost to a fault, too tight, leaving money in sales on the table sometimes, I think. Same thing with the European brands. You're just a higher price point in a lot of cases. Premium brands, you're just not going to do as much volume. It's the smart money, or the little bit more macroeconomically resistant buyer. So you can be a little bit tighter with inventory there. And then where you see the returns for the domestic brands not so good, a little bit oversupplied right now. The industry is right about at the peak. 65 days is about the top of where we look, and the three domestics, and I'm going to include Stellantis, the CDJR brands in there, are above 65 days, all three of them.
Let's talk fixed ops and used. What are you seeing on that side?
Yeah, and that's really the place that, and not that we're here picking stocks, but it's that revenue diversity for the franchise base that I don't think the media and the markets get. That is, everybody wants to talk about automakers and the OEs and Tesla and from a media and markets perspective, but it's really the dealer base and that revenue diversity that they can go to fixed ops when the new market starts to turn down or the used market is very tight. So I think great opportunity in fixed ops to diversify the revenue and the profit contribution. Fixed ops, I think, is the opportunity. The pre-owned market is very undersupplied, and 2025 is actually the worst year of it. When you think about low volume, total volume through the pandemic period, through the COVID period, and then no incentives, and you think about leasing as an incentive, it was high teens, right, from 30% lease penetration. So you have a low base with low off-lease vehicles. That market stays really tight to 2.5 million units off lease in 2025. Years prior, that would be 5 million, twice the size. So I think dealers are going to have a hard time finding opportunity in the pre-owned space, but that opens up the door to fixed ops and the new market too, because I think supply is going to be constrained there.
Big topic here. You coined a phrase with me on the Full Throttle podcast a couple of months ago, probably less than that now, the tariff pandemic.
Yeah.
So when we talk tariffs, what's at play in the tariff pandemic?
Yes.
How could this influence really the next quarter?
Yeah, and I think that was your word, and it's pretty ingenious, because I think what it means is that supply-demand balance that was super tight in the pandemic, the COVID period, is what we could expect if this is a prolonged tariff period. And while there are differences, one would be where the consumer is in this point of the macroeconomic cycle versus 2019 and earlier. The other thing to look at is that where supply was constrained for every manufacturer during COVID because supply chains were so disrupted, this could impact brands specifically differently based on what your manufacturing footprint in the US looks like. So we've heard brands like Jag Land Rover kind of halting production, Audi, Porsche, and any of those European brands that don't have any capacity here in the US are going to be affected differently than those that do. That can ramp some production here. So, but at the end of the day, the tariff situation could wind up being supply constrained. And when you look at what happened in the COVID period with supply constraint, it was wildly profitable, record profitability for the franchise dealer base, because instead of having 4 million units for 1.5 million of sales, now you have a declining inventory low, and it gets closer and closer. When that happens, prices tighten up, margins expand, and it's actually doing more with less, right? You're doing more revenue and profit contribution with fewer units. So
A ray of light
it
in an
could be.
otherwise cloudy situation.
Yeah, it could be. And again, it's going to be different for every brand. I wouldn't paint that with a broad brush saying it's going to be like the pandemic period all over again. You know, those European import brands are going to struggle with supply a lot sooner than the domestic manufacturers would.
Couple more things: affordability, and how is it related to the picture that you just painted?
Yeah, this is not about creating affordable vehicles for the consumer. This is about manufacturing coming back to the U.S., expanding. You know, I think I read about Toyota increasing RAV4 production here in the U.S.
Nissan's going to fill its used.
Yeah, and there is under capacity utilization here. It was 65% in the fourth quarter. You want that to be close to 80. So there is an opportunity for those U.S.-based plants to increase production, but to absorb some of that demand that isn't being met by imported vehicles, and that includes Canada, Mexico, right? There's a lot of vehicles that are coming, you know, not only overseas but from North America that are now subject to tariffs.
Okay, what's the broader automotive outlook then, all things considered, all these factors that we've just thrown into the mix here?
Yeah, I think it's a smaller volume market, similar to what we saw during the pandemic, right? 2022, best year profitability-wise for retailers, was only a 13.8 million unit new vehicle market. I don't know that we get that low. I think it would. The lead time of tariffs in place is too long, I think, for the administration to let it go. You know, when you think about the pandemic starting first quarter of 2020, 2022 was the most profitable year. If you think about that, I don't think the administration can wait till 2027.
2 years.
Yeah, that's too far out there. But I think we have that kind of situation. Supply constraint, which is not all bad. It will be bad for some brands, but overall, it's sort of an unnatural way to align supply with demand and create organic profitability for the dealerships. And at the end of the day, when you think about even the pandemic period, it's a lot easier to find 13.8 million buyers at $49,000, $50,000 than it was to find 17.5 at 35 million. And you're doing more with less in that scenario anyway.
Final thing, we're happy to be ahead of the curve here, announcing some of these things really before the rest of the world. So tomorrow, Lithia will announce its earnings.
Yeah.
What do you think?
Yeah, and I think this is actually exactly what we're going to see. I think there was this great pull forward in March, and where you see that increase in dealership profitability that we see early in the NCM data, maybe just that last month of the quarter. And I think you're going to see a similar scenario for the publicly traded groups. We just have it a couple of weeks before that. And even April, we're starting to see that pull forward too. I think that what we now want to look at is how quickly do we sell down that existing inventory, because that's going to be important. That's where supply and demand get tight and profitability goes up. But from a dealer's perspective, your transaction count is lower, right? And that's where the used vehicle market or the fixed ops departments come in.
Right.
And that may be accelerated compared to what we saw in the pandemic, but it's going to happen.
Always great to hear your insights, Kevin. Let's hear what others have to say. Questions are already coming in. If you'd like to send us a question, please click the top right Engage button to be part of this broadcast. All right, so let's get to it. To continue on the tariff discussion, how should we think about the fluidity and performance of the tariff policies, Kevin? There's been some whiplash, as you know, in recent weeks as the administration's tariff policies have changed, sometimes quite quickly. So what's going to stick, and how should dealers approach their business going forward?
Yeah, specifically for the dealers, I think you want a little bit of scenario analysis, right? Think about nothing happens at all. With the stroke of a pen, it's all gone tomorrow, what that would look like. And that would be very similar to what we saw in the first quarter of the NCM data, turning back reasonable inventory levels. And then at the other end of the spectrum, we've looked at about 5 million units of supply in play, meaning 16 million units sold in the US in 2024, about 11 million were produced here. So there could be, let's call it 5 million, whether it's Canada, Mexico, or imported, that don't get built. And I think dealers should be thinking about something along that scale, where the undercapacity of factories in the U.S. would absorb some of those 5 million, but certainly not all. And in that supply constrained scenario, you're looking at higher prices, tighter inventory, and it's going to be similar to what we saw in 2022.
So interesting, higher prices and inventory issues. So, I mean, if I'm a dealer thinking about the scenario, and we alluded to that a moment ago, the world is not necessarily upside down. It just changed for some.
Depending on your brand too,
Right.
again. So if you are a full import brand, and Europeans, we've seen action by Jag Land Rover, Audi, Porsche, there could be a problem with supply much sooner than there would for the domestic manufacturers that not only have overcapacity and oversupply right now, but they also have the ability to add more production into their schedule as it stands now. So it would take them longer to run through their inventory than it would a European premium brand that has no capacity here.
Do you expect those automakers, we've seen this in the news a lot lately, those automakers to backfill on some of that, capacity that they have in the footprint that they have here, right? I mean, that's the idea.
That is the idea.
But it will take a while.
It will take a while. And again, if you're looking at 80% capacity utilization as ideal, and we ran at 64% and have been under 80% for 30 consecutive quarters, we could certainly absorb some of that. Now, the makeup of that production is very truck heavy, especially for the import brands, for not only the Asia-based manufacturers, but for the European. That's truck capacity here. It's an 82% versus 18% car market, 82% truck.
Right.
So that's where the demand is, but that would be where you would see additional builds being done.
Let's go back to some of the NCM data. I know it's a little bit rear view, as you said earlier, but one of the questions that we have here is, how do you try to project that forward as we look at gross profit per unit and other metrics like that?
Yeah, and I think the easy way to do it, right, is that 3 million units of inventory, right? And that's really a sliding scale, 4 million in 2019, and it comes down to 1 million in 2021, 22, and the reaction of dealer profitability to that. So the rebuild to 3 million and then that leveling out is a good sign, right? And you can see where that put profitability, not the peak, but better than it was pre-pandemic. So that's the way I'd be thinking about that forward. Without all the noise, industry seemed to be in a decent place, and manufacturers got a little religion, like you said, about their production output, right? So not a horrible place. Whether it's sustainable is really the question.
How about unit sales? There's a question about the forecast for unit sales. The question focuses on 2026, but let's look at maybe the back half of this year. I know the crystal ball is a little foggy here, but what do you...
Yeah, and my sort of half-joking answer is all of them.
Right.
The question is, they're all going to sell. The question is, how many are going to be built?
Right.
And then what is it going to cost to sell them? What is it going to take to get the consumer off the sideline? And in a supply-constrained environment, it's not going to take much in terms of money, right? Incentives, discounting, lease deals, whatever it'll be, because you have such a tight balance. Now, in a normal, no tariff and high inventory, then it would be a little bit expensive. I think before we got into the tariff talk, we were looking for a low 16 million unit. Maybe that's low 15 now in a worst case tariff scenario, and then heading out to 2026. Again, it depends, but you could see a little bit of growth. Even before, I wasn't factoring in significant growth from the 16 million we saw in 2024, maybe 200,000 units, 400 at the outside, but we weren't going 16 to 17 plus very quickly.
All right, just a reminder that you can engage with us with that engage button that's on your screen. Do you foresee OEM incentives, back to incentives you just mentioned, do you foresee OEM incentives decreasing due to those low inventory numbers, also leading to a decrease in sales? If so, how do dealers offset that?
Yeah, well, absolutely. That's incentives are simply inventory control, inventory management. That's their purpose. The problem you have is when they stop working, then you get into sort of structural cost issues. But in an environment where inventory and supply are tight, you're just not going to have incentives. And that's any kind, including leasing, which affects the pre-owned market going forward. So as a dealer, I would be expecting the longer the duration of this tariff talk and threat, the faster you're going to sell down inventory or not rebuild it, and the fewer incentives you're going to have. So I would be thinking about it that way. And again, that depends brand by brand.
By brand, yeah.
There's some brands that are oversupplied and can go 60, maybe even 90 days without really much of price action. And then you're going to have others that are lightly supplied that are going to pull back or have higher pricing much sooner.
On brands, we talked just a moment ago also about the differences between those who can produce here and those who are choosing not to ship here. And that list seems to get longer almost on a weekly basis. What do you say to those brands who just have either had a stop sale, or in some cases, Nissan has the example where they're not USMCA compliant, so certain vehicles built in Mexico can't even be shipped in because economically you're looking at 40+%
right.
in terms of tariffs. What do those brands do?
Yeah,
the
and
Audis and the Jaguars.
Right, and I think I sort of joke that it's an intern with a spreadsheet, right? It's a financial decision.
Mm-hmm.
Do you absorb the tariffs and continue to bring vehicles here? Do you pass that along to the consumer? Or try to at least. So there's all these different scenarios that the manufacturers are looking at. And then the question is also, when you think about it as an automaker globally, the units that I don't send to the US, can I send them to North America? Can I keep them in my domestic market? Or can I export them somewhere else? So there's a lot of movement going on in terms of production footprint that has to be decided by all these brands. But the bottom line is, it's fewer units, it's higher prices. I think that's the most immediate and imminent outcome.
Gross profit per unit for new vehicles is still falling fairly steeply. Do you expect that to continue? The question, and then I'll ask a follow-up after that.
No, I don't, because I think there was huge pull forward in March, right, with the threat of tariffs. Anything that was on the ground or even in the port was not subject to tariff. So you had, in a rare instance, you had real demand pull in March that you didn't have in even January and February. So that's consumer-driven demand for products, which doesn't require a lot of discounting, right? Because the demand is there. But as you go forward, and even early April has been very strong in terms of beating the tariffs. And the longer we go, the less likely that is to be that kind of case. So I would expect gross to actually increase. And especially if you have manufacturers not changing MSRPs. They may say, hey, look at us, we're not passing this along. MSRPs are staying the same. But as that supply goes away, you're going to have a condition like you had in 21, 22, where the dealer is able to command over MSRP for vehicles.
So this is related then. Tariffs aside, are we eventually going back to a situation where dealers don't really make money on the front end when selling new cars?
Well, again, without tariffs, probably, right? So again, if we go to 4 million units of inventory, we would be in that scenario. And then you would be looking at your other business units as the ways that really drive profitability. Now, there's benefit to having no margin new vehicle sales, you creating parts and service customers, right? Repeat buyers, even used cars, for family, whatever it is, there's benefits of selling vehicles at low margin. But again, it just comes down to supply and demand.
But related on other parts of the business, question, what happens to used vehicles in the higher tariff environment? Should I load up on used inventory now?
Well, the problem with that is that used vehicle prices are going higher too. I did a piece of analysis that over the longer term since 2009, used vehicle prices are 86% correlated to new. So essentially for every $1,000 a new vehicle price goes up, the used is going 860. So there's not that much of an affordability gap for the consumer, or even in terms of acquisition costs for the dealer. The other thing is, I think that the used vehicle market is very undersupplied because we were low volume on new for the past couple of years. COVID, no leasing, which is an incentive.
Right.
So it's going to be very difficult for dealers, even if they wanted to load up on used, to be able to do it.
Affordability we haven't really touched on yet, but the questions come in. During COVID, the U.S. government gave the consumer disposable cash, and the consumer had the least amount of debt in decades. So Kevin, all that money's gone. Consumer debt's back extremely high, as you know. Can the consumer handle the higher payments on new vehicles while they're already stretched?
Yeah, that's a very key difference and an excellent question. Because you got to remember too, we went through that period of the pandemic where we didn't travel, right? We didn't commute, right? So you had all these transportation related costs that were not going to vehicle upkeep. Maybe there was some catch up on maintenance and repair, but there was a lot of excess money, that the consumer had at that particular time. But that's one of the key points. And when we talk about the tariff pandemic, like we mentioned before, the difference between now and then, that's one of the key ones is the consumer in a similar place? And they are really not. It's not Armageddon, end of the world for the consumer, but you're talking about higher interest rates, higher average payments, longer loan terms, so you have a lot of consumers underwater on those vehicles.
Great. Just a couple more questions. Does Amazon get more or less aggressive entering the automotive market, given the foreseeable market dynamics that are unfolding?
Yeah, that's a really interesting case. To me, I feel like for Amazon, the opportunity is on the used vehicle side. And
which they've talked openly about just recently.
Yeah,
FanGen.
and it would seem to me that if anybody had asked, which they didn't, that would be where I would have started, because it seems like it's less of a threat to or more of a benefit for the dealers to align with Amazon on their used vehicle inventory, right? More eyeballs, more clicks, a brand name. I think by going to the new vehicle side, you have to convince the manufacturers to be on board, which makes the dealer base a little bit suspicious. So I think the opportunity there is on the pre-owned side faster than it is on the new vehicle side. Right? I think there's just there's more parties to convince on the new side than there is on the used.
And they've been very open about their intentions, and they're partnering with dealers, including just last week, obviously in New York.
Sure.
Yeah.
Sure, but the threat there on the pre-owned side is that there are some very large and global companies, AutoTrader, Cars.com, CarGuru, that are essentially that kind of platform for dealers to be involved with, and they're already involved with a lot of those platforms.
Right. Final question, since we have you here, thoughts on Chinese automakers entering the U.S. and or Canada? So obviously the global map is evident that the Chinese automakers are everywhere except two countries.
Yeah, I would say not in the next 3+ years.
Right.
After that, it remains to be seen. And I don't have a direct answer, but one of the things I find interesting about that argument is we talk about affordability, right? These would be manufacturers that could come in and satisfy that demand profile at the bottom of the market, the entry and move up segments, and no other automaker wants that. Every automaker has run away from the entry level in this country. So it's an interesting...
Abandoned.
Yeah, abandoned it, right? So it's an interesting dynamic that we don't want them in, but we have no affordable vehicles.
Yeah, there's an opportunity there for sure. He is Kevin Tynan. My name is Jason Stein. It's been wonderful to be with you. There's a QR code that is on your screen where you can download the latest report, the report that we talked about here. Kevin, thank you so much for all of this, and great to be with you again. We'll see you next time.